and thank you for, as you mentioned, being here for the penultimate panel. I'm actually moderating the ultimate panel, the last panel tomorrow, so I hope everybody will be here for that as well. So when we had a pre-call, so our title is, has FOMO passed? And I think that was created sometime maybe in May. We actually had a panel for our association about crypto venture, and it was noted then, 9 months ago, and you're at a pension plan, you talked about crypto venture, that's a career-limiting move. And this is February, and in February, this is actually a career-limiting move if you don't know about it. Now, we're going to hear about maybe where it is right now, but, and I guess we're kind of the bridge between Private Equity Venture Day to Digital Assets Day. So I think this will be a lot of fun, but maybe you have to rename it, has FOGA passed, fear of getting annihilated because of all the things that have been happening the last little while. So let's start with introductions, and we'll just quick intros, and we'll get into some of the questions. Mariusz.
Fantastic. Thank you for having me here. My name is Mariusz Adamski. I'm a partner at FFVC. I manage global venture capital early stage. We were originally founded in 2008 in New York City, also during the financial crisis. A few years ago, we actually did expansion into Poland as well. So currently we have 2 offices, 1 office in New York City, 1 office in Warsaw. We primarily target early stage businesses at seed up to Series A stage. And our big thing is right now we increasingly putting more emphasis on Central and Eastern Europe, where we try to find extraordinary founders and bridge them right away to the US.
Very cool. Arjun.
Let's see. So run 2 organizations today. One is a crypto DeFi protocol called Nibiru. So it's a decentralized exchange, derivatives, perpetuals market, and a stable swap mechanism. This kind of started that last year. And about 5 years ago, started Tribe Capital. It's about $1.5 billion in AUM. We basically invest across early, mid, and late stage, public and private, but mostly private. And then we have about 4 funds across venture, equities, and crypto. That's about it.
Excellent. The whole gamut. I love it.
Yeah.
Fikry.
Well, at Lumina Capital Advisors, we are mid-market M&A and corporate finance advisors. We have presence in 3 main markets, Dubai, London, and Riyadh. And we work on matching capital and transactions across these 3 markets. Lately, we're very busy on the Riyadh-London corridor. There's an increasing traffic on that corridor in terms of Saudi investors investing to import expertise and capabilities to the kingdom, and UK investors looking to scale into new markets.
Very good. Maybe continue with that. Like, how would you describe the Middle East market, specifically Saudi and such, and compare it to those around the world?
Well, I think on the VC space in particular, I think today we might have seen a slowdown in the growth trajectory, but I think we're still growing. The growth now is shifting to more rational growth as opposed to like fear of missing out growth.
Yeah.
I think we are starting to see that there is a distinction between tech and tech-enabled companies. People didn't have that distinction earlier, and the same valuations were being applied to tech and tech-enabled. There was not much consideration for the underlying cash flows. It was driven by multiples valuations, and again, fear of missing out. Today, in the region, we have just touched $3 billion of VC funding. In Saudi, in particular, we've just touched $1 billion in VC funding, and if you want to compare that to the GDP and the macroeconomic environment, we're nowhere close to saturation or anything. We might have been saturated in certain segments or sectors, e-commerce, for instance, but we're still scratching the surface when it comes to sectors related to deep tech or AI or agri-tech or biotech and such.
That sounds so similar to Canada because we have Shopify and all these other things that have kind of blown out the e-commerce side.
Yeah.
Mariusz, you wanted to kind of maybe on our pre-call talk about the difference between traditional venture capital and crypto. How would you discern between the two?
So we at FFVC, we actually never invested in crypto businesses. We've been since 2008. We've seen multiple cycles. We've heard multiple buzzwords in the past, and here actually we sort of stay away from this. We're particularly interested in investing in business, but mostly platform-based businesses that sort of touch upon cryptocurrency or blockchain. However, as a traditional VC, we actually value ourselves actually certain provisions within the framework that provides us, with some advisory. We didn't see the same thing, investing in crypto. Therefore, we sort of stay away. However, we've been studying the markets and thinking about, when to potentially attack it.
Excellent. Arjun, I'm sure you have an opinion on this, on crypto.
On what specifically?
F? Do you want to go there yet? We have a half-hour panel, but
Yeah. The word FOMO is like a pretty negative connotation, and I think the thing is FOMO is never going to pass, right? So you can make the argument that we're in reverse FOMO right now too, which is everyone's kind of retreating from anything that's technology or tech-enabled software, et cetera, and they're moving towards what they believe is sort of safe. So obviously, in the regions like oil and gas, you see sort of healthcare in sort of the Western markets, and it's you see these ebbs and flows, across the board. I think the right way to think about it is in 1999, we peaked at 100 billion in venture capital. I think over the last 3 to 4 years, we've deployed around $1 trillion into venture capital. And the way to sort of think about it is with the retreat and the reset that we're having right now, given where we are with the rates, which I don't think will change too much in the next 2 to 3 years. Is that I think you'll just have about 800 billion of that trillion just go poof, And what I mean by that is that depending on where you are, which markets, Southeast Asia, Latin America, any of these emerging markets where they don't have liquidity or they don't have subsequent rounds of capital access, they're just going to have a harder time being able to scale at a certain velocity. So either those companies get to a place where they have command over their own destiny, which is cash flow positive to cash flow break even, or that they're able to figure out a way to get to sort of what I'd say these growth access to capital. And I think most places just won't be able to get it. And so when you take a look at the traditional markets that have access to it today, with the markets, it's essentially just US, China, and India. And then you have a sort of sprinkled markets out there that might have some access with it. That might be Western versus Southeast Asia. And the rest of them kind of, out of luck for the moment. And it doesn't mean that it won't come back. It just means that, FOMO just basically meant, in my opinion, that everyone wanted to invest into the category of something that was defined as technology. So that could have been the equities market and the public markets, could have been the private markets, as you've seen. And so when I think about crypto losing $2 trillion over the last 2 years, but where it was 10 years ago, or I think about where tech was 10 years ago or 20 years ago, and 38 trillion being lost in the last 2 to 3 years, I really kind of think of it, which is how do I think about that excess of capital demand into certain asset classes versus not? What's that supply look like, and how does that keep moving in and out? So I think it's the word FOMO for this category. It just really depends on what you're looking at, and crypto, I think, probably not too dissimilar to software businesses. 10 years ago, if you asked somebody what is a SaaS company, they would have just thrown their hands up and said, I have no idea. And frankly, if I asked most people what is a SaaS company, what does it look like today, what does the gross margin look like versus recurring, they're not going to be able to answer. And so I think most investors don't really know how to assess companies across the board, except for traditional brick and mortar, where you look at sort of gross margins and some sort of stability on accounting and finance on a quarterly financial basis. And for software, you have to take a look at engagement, what's recurring, what's not, what are those gross margins, what's traditional software versus services. And to his point earlier, he had mentioned what's tech-enabled and what's not. The reason why tech-enabled companies got such large valuations was that their TAM was so large. And so even if their gross margins are lower, they could grow 1,000, 2,000, 3,000x. And so everyone kind of forgets to compute that and makes this mistake over and over and over again. And it's not that all companies are equal, it's just more about where's that concentration of capital.
So what do you think it takes for a region or a country to make it from where it might be to the U.S. or the developed market status, like in the venture state? Like what kind of ecosystem is required?
You asking me?
Yeah.
Sure. So we do a lot of bottoms-up quant analysis, and we work with some of the sovereigns here locally as well as some other regions. I think so you have to take a look at history as well, which is in the U.S. you had a couple of things. One is concentration in capital into a very small set of companies. So from the 50s all the way to the 90s, it was essentially hardware companies. Then you sort of thought about like networking and switches and chipsets. And again, I'm going sort of fairly quickly on the historic aspect here. And so what happens is you have concentration of capital, you have concentration of talent, and then you have more and more people that are thinking about adjacencies of the ecosystem that can be built. And so when I think about other regions, China had to do that vertically integrated when they started building, from e-commerce companies to search companies, so JD, Alibaba, Tencent, et cetera. So you take that and you say, okay, what is it that they needed to build? Well, they built the expertise vertically integrated. Then they started bifurcated and made sure that the ecosystem could support each other. And then when you take a look at India, it was the opposite effect, which is extremely fragmented, which is more redundant software engineering for outsourced companies, mostly based in the Western markets. And then they started building out their own ecosystem. E-commerce really didn't start to what I call wave 2 of India, which is, let's call it post-2010. And that's really what's helped them to take off. And then their liquidity markets and their public markets didn't really, again, start to, let's say, 2015 plus. And so I think that ecosystem matters in order to support itself. So when you take a look at Latin America or even Southeast Asia or what folks are trying to do here, I think actually the concentration of capital, talent, and making sure they have access to liquidity, or frankly just capital, means more than trying to spread your bets across 500. It's more like just spread your bets into like 20 to 50.
Fikry, when you think about Saudi, we think about lots of capital. And in our pre-call, and even just this morning, you were talking about like how it's changed in the Middle East, that ecosystem is being built up. Like, and that's the same story I heard 15 years ago. Canada had $1 billion, and then now there's $1 billion funds being raised.
Yeah,
in
absolutely.
So let's hear about a little closer to, I can say closer to home, but closer to here.
Yeah, I think in certain sectors, we are starting to see that certain sectors are being unlocked, or increasing investments are pouring into that. Fintech is one of them, because the regulators are shifting from conservative regulators into regulators that are willing to listen, to experiment, to have a sandbox environment that's supportive of innovation and trying new things. So fintech is something that I don't think we have seen the end. We're still growing in the early stages of fintech in the region. In terms of VC funding per capita, I think if we want to compare it to Canada, where it was like 15 years ago. Today, VC funding per capita for Saudi is at $20. And we just touched that this year.
Yeah.
If I want to compare that number to VC funding per capita for Canada, which is a similar, a close population base, Canada today is at $270. Australia, with similar population base, is around $140.
Room to grow.
Another country that is at $20 per capita is India, but India has 40 times the population of Saudi Arabia.
True. How about for you, Mariusz? Like you're in Warsaw, and your head office, I believe, is in San Francisco. So how is it? What is it like being out there? Where you're situated, and like going through COVID and such. Has that changed things that people thought, man, we should think maybe more about these other areas of the world here, because of like I have actually embraced Zoom somehow. Before I would never get on one, but now. Has that changed anything that you guys have been doing there, and have people been more open to other ideas of that? Or?
Well, definitely. I mean, during the COVID, we started a new office in Warsaw. So, like, our view is that we believe that the world is flat, just unequally distributed. So we look for pockets of money, pockets of value, pockets of different regions where we think there can be the next new thing. And Central Eastern Europe actually had multiple points that actually we really like. So obviously super talented people. They've actually evolved from IT outsourcing to the US, so that they actually knew how to build products. You also have the inflows of European capital that's flowing into the system and supports the innovation. And therefore, we actually, even right now, we see the growth in terms of VC spending in the region. And also the emergence of really great products that are coming out of Central and Eastern Europe. And the COVID definitely helped. Obviously, connecting to the founders globally. People also adjusted, how they manage the teams. And then one very important aspect, like where we invest, we look for capital efficiency. So right now we actually change. Last year people thought about growth at all cost. It was really easy money flowing to a variety of projects, sometimes even mediocre projects. But Europe actually, especially Central and Eastern Europe, actually was very, very capital efficient. And we have a couple of charts in our presentations that actually show that for the same amount of money, Central Eastern European companies generate 4 times higher revenues. The development cost is 4 times cheaper. So for the same amount of money, you can build better, faster, cheaper products that can scale globally. And the COVID actually showed that you can scale from anywhere these days.
Thanks. Arjun was listening intensely. Are you looking to get into Central Eastern Europe as well, or?
Not really. I think
Or where do you see the growth?
Yeah, I think sort of like the counter narrative is a lot of people focus on Europe opening up, and I think of Europe as sort of a sort of failed ecosystem of stagnating sort of economies, mostly from a sense of sort of like entitlement programs and sort of like where they are in the socialistic economy. So it's more of a macro thing. And when I think about where most of the opportunities look like from an arbitrage perspective, I think of growth markets, right? So I still think of US, I still think Latin America, I still think of Southeast Asia, obviously China. We don't invest in China, but I kind of look at it more closely as a market. And the reason why I say that's the case is that when you think about productivity growth and the delta and the spread of how much more there is room to grow, Europe's like slim margin. That's kind of how I think about it, right? So decelerating population, aging population, not too dissimilar to Japan. I don't think anyone in the room here is like, I can't wait to invest in Japan. So when I think about all of the markets and where you can have most of the disruptive technologies, or as you mentioned here in Saudi Arabia, we talk about financial services. Financial services worldwide is like 70% of the world GDP. Everyone kind of forgets that. And so where is that going to have the most impact? It's going to be in all of these emerging markets. And you need to be able to assess, invest, and sort of look at that and underwrite the risk of where all these returns are going to look like. And so I think when you think about alpha-style returns for a certain pool of capital that you have, I don't think you can be like just European focused. Again, that's just my personal perspective. It doesn't mean that there isn't going to be good European companies that are built there. But if you take a look at the ones that have been the best and the brightest that have scaled, most of their markets exist outside of Europe.
So maybe I elaborate a little bit on this. So Central and Eastern European countries are relatively small countries. So like Poland, Czech, Estonia, Hungary. It's very difficult to build really large business on just the internal market. So therefore, where we came to the idea to actually establish office in Warsaw is actually to create a bridge to the US. And what we realized that Ukraine, Poland, Estonia, they're extremely capable people in terms of building the products. However, they're missing one element, sales. And the sales actually comes in the US. So if you could connect sales with the great products, this combination should lead to superior returns. Without the sales, without the bridge, you're absolutely right. Europe as a standalone business is probably actually as an investment thesis might not make sense. But at FFAC, actually, we built global businesses.
I agree. To his point, I think what you see in Europe is you're going to have this recirculation of they're going to be bent towards making sure that they can build products and market towards the larger economies. In this case, right now, it's the US. But you're also seeing, like, I have 3 portfolio companies, and we all already out from India, and we all outsourced to Poland and Ukraine until recently. And so what you're seeing is kind of like this reverse outsourcing, right? Whereas India used to be sort of like the opposite side of scaling out, and now it's like, hey, these Indian companies need talent, and they also have a need for the war for talent, and so where they're going. So they're hiring people in the United States and they're hiring people in Europe. And said it kind of makes sense. But again, I don't necessarily think that's good for the European economy. And that's kind of how I think about what the investment class looks like.
How about in Saudi? Are the companies there looking outward for their markets, or is it mostly the MENA market?
I think with what's happening in the region, the focus today is local and regional. Simply because a lot of the investments that are happening today are in early stage. There's a huge gap between what we have locally and regionally and where the world is. So there's a huge opportunity for investments locally and regionally. A second factor, I think, is that there is a lot of government funding that's going into encouraging and unlocking the VC investing in the region. Saying that, I would say today, the bulk of the investing that's happening in the region is today on the early stage, or the bulk of the local funds that we have are on the early stage side. And I think we will start seeing more local funds. I think, to me, this is the upcoming trend of local funds or regional funds moving towards the mid-market or mid or late stage, simply because today late-stage funding has been happening through international funds that are deploying with the likes of Sanabil in Saudi Arabia. Sanabil is an LP in those funds, and they're acting as a catalyst to attract those international funds, and they're filling basically the gap of funding late-stage opportunities. Going forward, I think we will start moving from local and regional funds in the early stage more towards the mid and late-stage funding. I don't think we have secondary funds in the region. It's still something that we haven't seen yet. Follow-on funds, I don't see follow-on funds in the region. So I think we have a lot to catch up. We're evolving into more mature VC environment.
You mentioned government investments as well. Like in Canada, we have the EDC, Export Development Corporation, BDC, Banque de Development de Canada. So they have actually, they make money for the government, which is kind of bizarre for a government organization, because they actually find early stage companies and invest in it and help them through. So maybe we'll start with you, Fikry, and then we'll move on. So how involved is the Saudi government or other Middle East governments in setting up these types of funds to encourage that? And do you think it's a good thing? And then we'll go to Arjun and Mariusz.
So in Saudi, there's your question is on how involved is the government?
Yeah, specifically maybe government venture funds if
yes.
exist.
Okay, so and no, there is before the government pension fund. So I think the government pension funds, they have deep pockets. They only invest in the hundreds of millions, and they're not looking at this asset class yet. What's happening is there is Saudi Venture Capital Company, which is a company that was set up by the government, and they basically have matching programs. They invest up to 50% in funds. They invest up to 50% at the level of the opportunity, and sometimes with angels. So they have these government programs. Today, I think they have the size of the fund is around 1.8 billion Saudi riyals. That's like around $450 million. And they've been, I think they're like 4 years old, around 4 years old. So that's the main thing. Of course, there has been like several initiatives to improve the environment, the regulatory regime, the ability. Saudi didn't have the company law did not allow for certain things like options and
Stock-based compensation.
Yes, yeah. So there's a lot that's happening on that space.
So I got a special question for Arjun in a second. I'm just seeing our time's up, but I'm sure that's early. Involvement with government funds at all in the U.S., or is that a big thing?
We work with the pension funds.
Of course, yeah.
So I wouldn't really call them government. They're mostly financially returns driven in order to hit their milestones for payments.
So actually, when we started in 2008, New York City wasn't well known for startup ecosystem and venture capital. So we actually we started the first funds with New Jersey State and New York State. Obviously, right now it's probably 99.9% of private money in the New York ecosystem. And when it comes to Europe, probably 90% is still subsidized by or supported by local governments as well as European Union in terms of helping and helping to accelerate the growth in innovations.
And for those of you who are still here, I love it because Arjun, of course, Tribe was in the capital stack for FTX. Let's hear something about FTX that we all haven't seen in the YouTube videos. No proprietary or secret data, but like, do you have anything new? And it's the most current big blow up lately, unless somebody is, unless something's happened in the last 30 minutes.
Let's see what I can say. So I think, and this is something that I've said before, and it's not, I'm not saying anything completely new, but the way to sort of think about crypto is, not too dissimilar to think about the internet, is that, crypto's like talking about equities or currencies, right? Like there's a huge amount of the ecosystem that's being built and will continue to be built. And when you think about, the early blowups of the internet and then the secondary blowups that you had subsequent to that, I think there's always a way to sort of think about how to define what crypto really means. And so to me, crypto is, there's an accrual of value in the tokens, which, and I advise the Senate Banking and Financial Committee, and I just literally say a governance token is a security. And then there's commodities and there's stable coins, and there's different systems and mechanisms to connect with each other. And the other aspect is you have to think about crypto, I'm sure you probably think about, is that there's the picks and shovels of crypto to enable what's happening in the ecosystem. Which is essentially equity accrual or value. And then there's like the tokens, which is like there's a certain amount of contributors or people that are able to participate while there's an accrual of value. But if you think about any protocol, they're not any different than a company. They have a treasury, they have a governance, it might be just by the community, they make money through transactions, and so you can measure them intrinsically, not any differently. Again, I'm talking about DeFi more specifically. And when you think about all the blowups that have happened in crypto really early, it's usually because there's an institution and a human in the loop, rather than something that's on-chain or within a smart contract or transparent in front of you. So when I think about like Curve or Aave or Uniswap or any of these companies, again, in the finance sector, none of them have had any issues. They've had no solvency problems. They have no liquidity issues, at least today. There have always been some things that have been up and down. There's wars with each other. But most of the issues have been with like Celsius or FTX, 3AC. There's now DCG with Genesis. And all of these companies are traditional finance companies. None of them are decentralized finance protocols. And I think like it's important to distinguish between the two of what that really means. And then the other aspect I'd say is, for FTX specifically, the way in which Binance, and we're investors in Kraken, Binance, Binance.us, FTX, FTX US, so we've kind of had exposure across the board. And so while one has gone down, the more have gone up. And so that's great for us as investors. Not so great for customers or on deposit. And I think first and foremost, FTX.com was a non-regulated company based in the Bahamas. And then two, they had FTX US and a couple of other institutions or assets that were based in the United States that were regulated. And those are kind of more subsided and I'd say like safer as assets. And most of our capital was in FTX US, so sort of fingers crossed. But I think what you see is that you can't really diligence someone who decides to commit fraud in the future. What you can really assess is like, where is the company today? Where were they in the past? What's the speed at which they're growing? And when I take a look at any of these companies, how many companies have you seen in the last, even 10 years that go from 0 to billion in revenue in 10 to 12 months? Almost zero. And so we've seen so much of this accrual of value in centralized finance crypto companies as well as DeFi protocols. And I think it's kind of just important for us to understand really what is FOMO versus what is not, and how to sort of intrinsically value these assets.
And just keep the trust, keep the faith, man. Because Nick Leeson had some great trades in the '90s, and of course blew up spectacularly, took down Barry's Bank. But we're still trading futures, aren't we? Thank you, and join me tomorrow for our DeFi panel. We're going to talk more about that.
Awesome.
Thank you, guys.
Thank you.
Thank you.